So I wanted to welcome everyone to the Alternative Investments panel. We're super excited to have everyone today. My name is Kevin Sokol, he, him, his. I'm an admissions director, and I'll be sort of in the background, but we'll have both Charlie from Warburg Pincus and Jamie from Point 72 who will be helping present sort of the initial industry focused, and then we'll have our fantastic panelists who we will do more detailed intros on later in the session. But I think that I'm going to start sharing my screen, and then I'll hand it over to Charlie to sort of start working on the private equity portion of the session.
Great. Hi, everybody. I'm Charlie Rudlick. I'm a principal with Warburg Pincus. Thank you all for joining today. I had the privilege of doing this panel last year, so it's really exciting to be back doing it again for the second time. So I'm going to talk briefly about sort of capital markets as the backdrop for what we do in private equity and in hedge funds, and then I'll spend a minute or two talking about what exactly private equity is and what I do, and then I'll turn it over to Jamie to do the same for hedge funds. So hopefully you can all see the slide that Kevin is sharing. This is really meant to sort of frame the discussion by grounding us in capital markets. So businesses need to raise money all the time, right? Whether it's to build a new factory, invest in a new product, and anytime they need to raise money, they have sort of two fundamental options. They can either borrow that money, which is raising debt, or they can sell ownership in the firm, which is raising equity. So on the debt side of the slide, you see, you have the option to go either to a bank, Wells Fargo, Goldman Sachs, JP Morgan, and raise it via a loan, or you can issue securities, which is public debt or bonds. And I'm sure you've all heard of the Fidelities and BlackRocks of the world that invest in bonds. If you want to sell equity in the firm and sell ownership instead of raising debt, you again have two options. You can go to the private markets and talk to a private equity fund like a Warburg Pincus where I work, or you can go to the public equity markets, which is the stock market, and you can do an IPO or sell stock if you're already public. So you have this entire spectrum of options to choose from to raise money. And you'll note that some of the players on this slide span multiple categories. So whereas Warburg Pincus, where I work, private equity is all we do, Point 72, where Jamie works, looks at multiple of these categories and invests across different pieces of the capital markets. Kevin, can we go to the next slide? And so just a couple of things to think about on the differences between private versus public equity. One of them, which is really important, is control or governance rights. So in private equity, we're typically sitting on boards. We often own a majority of the firm, and we're able to make decisions in collaboration with management. Public equity is most times, there are exceptions like shareholder activism, more of a passive investment strategy. So you're acquiring stock, but you're not actively participating in the management of the firm. Second is information. So one of the things about private equity is we're insiders of the companies that we invest in. So we get very detailed operating reports, monthly financials. We're on calls with the CEO once a month. Public equity, it's quarterly reporting. You get shareholder reports 4 times a year. There's probably a conference call where the CEO and the CFO will give an update on the business, but that's sort of the extent of the information that you're entitled to. Third, and this one can go both ways, is investment horizon. So, and it's tied to the fourth point, which is liquidity. So private investments typically have a longer time horizon, and you have less ability to trade in and out of your investment. So that's called having lower liquidity. Public investments, one of their key benefits is, if I buy stock today, I can sell it tomorrow if I change my mind. That's much harder in a private setting. And then the last thing we think about as a difference between private and public equity is often risk. And I put a question mark there because a lot of times private equity is perceived as riskier than public equity. I would just encourage you to think about, is that really true, right? Risk gets measured along a bunch of different dimensions. Certainly there is risk involved in public equities. The illiquidity associated with private investments certainly is a dimension of risk, but there's also a question of whether you can manage that risk better on the private side by having control and access to more information. So with that as a backdrop, thank you, Kevin. Let me spend a couple minutes talking about private equity, which is the world that I live in. And then again, I'll turn it over to Jamie to talk about hedge funds. So what does a private equity firm actually do? And I would say fundamentally we are intermediaries and we are allocators of capital. So our investors, the people that give money to Warburg Pincus or other private equity firms, are organizations with capital to invest. That could be public pensions, private pensions, university endowments, charities, and in a lot of instances, family offices as well. And then the one that I didn't put on the slide is sovereign wealth funds, which are an increasingly important part of this market. They give us that money and they ask us to invest it for them on their behalf. So we are allocating capital to companies that need to raise money, like we talked about on the capital markets slide. And I'd say one of the important things about a private equity firm, right, is because we have capital that is illiquid and we make investments there for the long term, we have the benefit of being able to take a long-term view and focus on maximizing value as opposed to quarterly earnings or sort of what's popular in the moment. So how do private equity funds actually work? First of all, I'd say there are many different flavors of private equity, not just one. Everything from venture capital, which think about being the first investor in Apple or Facebook or Google, through to leverage buyouts that you might read about in the Wall Street Journal, where you're taking a very large, mature company private and helping it grow from there. There are all those different flavors in between of what private equity really is. So don't think of it as a single, uniform investment strategy. What does it look like for the investors? So typically an investor is making a 10-year commitment. The fund will have the first 5 years to invest in interesting companies, and then it'll have the next 5 years to harvest those opportunities, whether it's taking them public, selling them to another firm. And importantly, a feature of private equity firms is that our commitments are drawn down as investments are made. So if you invest $100 in Warburg Pincus, you're not going to write a check for $100 tomorrow. You're going to write checks over the first 5 years as we find interesting investments to put that money to work. And then, of course, a topic that's near and dear to all of our hearts: how do we get paid? One of the important features of private equity is that we think that we're very well aligned with our investors. So although we do charge a management fee, so if you invest $100 with Warburg Pincus, we're going to charge you $2 a year to sort of keep the lights on and pay the salaries of the people that work here. By far, most of the money that we're going to make comes from our performance fee, which is called carried interest. So if I make $100 profit on that $100 that you gave me, we, the firm, are going to keep $20 of that. And obviously, one of the key benefits of that is that I only make money when my investors make money. So our incentives are very well aligned in that regard. And then the last point on this page also speaks to the alignment of incentives, which is every investment professional of a certain seniority at a typical private equity fund will have to put money directly in the fund themselves. So we will never ask our investors to invest in something that we're not investing in ourselves. So we have real skin in the game and alignment of interest. I won't spend a ton of time on this page. I just thought this was an interesting case study of, the world that I live in. I talked about the different flavors of private equity. I focus primarily on leveraged buyouts, which are sort of later stage, more mature companies. And a lot of times a question that I get when I first start explaining how leveraged buyouts work is, why do you use debt as part of the investment? And this is really just meant to show that what debt does is it amplifies the return of the equity, right? So in this toy example, if I buy a business for $100 and sell it for $200, if I did that all with equity, I'd make 2 times my invested capital. In that same example, if I bought the company half with debt and half with equity, I can make 3 times my money on that investment. So obviously that's very appealing when investments go well. The cautionary tale, of course, is you can't amplify the return with debt without also amplifying the risk. So in this same example, if my $100 company became worth only $50, instead of only losing half my money, I'd lose everything. So you need to think about it as having an impact on the upside as well as on the downside. And then to close, let me talk a little bit about careers in private equity. So what are the things that I actually spend time on in my day-to-day life? And I break that down into sort of 4 key activities. The first is deal sourcing. So I spend a lot of time looking to meet interesting companies and management teams, finding investment opportunities. That can involve going to conferences, networking with industry experts. Once I've found or sourced an interesting opportunity, then I spend time on deal execution. So that's the deep due diligence of figuring out what makes a business interesting, modeling out what I can pay for it, and then also a bunch of potentially less interesting things like talking to lawyers and accountants to make sure that everything is clean and good. Then after I bought the business, after we've executed, it's portfolio management time. So it's going to board meetings, helping set strategy, helping the company think about, is there M&A that they should be doing? And then finally, after what is typically a 5 to 7 year investment horizon, it's time to sell the business. So this is sort of the full life cycle of a private equity deal and a private equity professional's time. And Kevin asked me to spend just a minute on sort of what are the pros and cons of private equity as you're thinking about it as a career. I'd say the big pros, it's really intellectually stimulating. You get to wear a lot of different hats, meet a lot of different people. It can be very financially rewarding, which of course, you don't want to gloss over. But I'd say, look, it's not without its drawbacks as well. It's a hard job. We work long hours. It can be unpredictable when you're working on a deal. And then last but not least, look, most of the Wall Street Journal headlines about private equity are not nice, right? So you sort of have to develop a little bit of a thick skin and be okay with that from time to time. So with that, let me turn it over to Jamie to talk a little bit about hedge funds.
Thank you. That was, I'm assuming, Kevin, you can hear me and everybody can hear me? Okay. That was such a great introduction. Let's see if I can match that. And I like some of the charts and graphs. And if I recall, my next slide actually is a lot of words. So I hope everyone's having a good day today, and I would love to sort of take the other side of the investing spectrum and talk a little bit about public investing, specifically, what is a hedge fund? And there are a lot of words on this page, so I will go over it, but then I'd also really like to just talk about what these words mean. My own background, I run investment professional development at Point72. I've been there now for 6 years. Prior to that, I started my career as an investor in the hedge fund space after, some initial time spent in banking and on the sell side of Wall Street. And I invested for several years, and then I actually became a professor at university myself because my passion has always been for to teach, and so I developed that into a program at Point72 where we really train people, hopefully who are listening to this this broadcast today, to become our investors of tomorrow. So I like to take things like this and just sort of say, what does this really mean? A hedge fund is an investment partnership. So I'm going to read the words first. That falls under an exemption from registration under the Investment Company Act of 1940, where basically the hedge fund manager manages qualified investor money. What does that actually mean? It means that a hedge fund is an investment vehicle, just like a private equity fund is an investment vehicle, where we are given certain freedoms and in exchange and relaxations from certain investment company restrictions, like mutual funds might have, in exchange for protecting investors and only limiting our investment in the vehicle to protected investors, or what we call qualified investors. So said differently, you have to have certain qualifications to invest in a hedge fund, and in exchange for that, the hedge fund itself can have certain freedoms from restrictions, like we are able to short sell or take on leverage, which a mutual fund cannot do. And that's kind of what this next bullet gets into. We're not subject to the limitations and restrictions under the Investment Company Act that are meant to protect retail investors like you and I who might invest in mutual funds. And so these other investors who invest in hedge funds are considered accredited. Who are those? Those are the kinds of investors you saw on the previous page in private equity, such as institutional investors, pensions, endowments, sovereign wealth funds, family offices, and so forth. They tend to not be people like you and I. So hedge funds are able to take greater risk in regards to position sizes, types of investments than retail products. And again, it's because of that difference in the amount of risk we're allowed to take because of the types of investors that we have. Hedge funds also have differing strategies. They can operate in a variety of financial markets, all of which are public, but we used to say all of which were public, but the truth is we can also invest in private investments as well. Whatever our strategy might be, the goal is always the same, and that's to make absolute returns greater than zero, whether the market is moving up or down. So we are agnostic to market moves, we care about our own returns, and we orient our strategies to such that we can produce positive returns in any market. Now, how do we do that? Sometimes markets go up, sometimes markets go down. How can hedge funds always produce positive returns in either situation? Because we can take long and short positions in financial instruments. So, for example, a long investment, for those of you who probably know, you can buy a stock and the stock goes up and you make money. A short selling position is actually the promise to repay the money for a stock later in exchange for getting the money now. So in other words, if I were to short sell a security, I would get the money for the value of that security today. Let's say a stock was trading at $100. I receive that $100 today as a loan. And then later on, I could repay that loan at whatever the current market price of the stock would be then. So if the stock goes down from 100 to 90, I only have to repay $90 later. And there's a lot of mechanics that go on behind that. But then you can see how you would profit that $10 in a down market. So hedge funds are known to take short positions in securities. And that's the way that, for example, we make money in downward markets. Hedge funds also can employ leverage to amplify returns. I mean, that was discussed previously. This can also increase the fund's risks. Mutual funds, retail vehicles cannot do that. Hedge funds are able to do that. So those are some ideas about what hedge funds do. If I can just take a step back for a minute, what I think is also important to understand about hedge funds is it's this sort of amorphous name where there's a lot of different types of strategies around certain investments. But at the end of the day, they're always the same investments that everybody else can make. They're investments in equities, or they're investments in debt securities. It's just a question of how we construct it to produce a return that can be differentiating. Hedge funds today manage trillions of dollars in global assets across multiple classes, as I mentioned. And we offer a lot of different options. You know, we have a mandate. Every hedge fund has a mandate or a way that they say they'll invest, and they have to stick to that mandate. As an investor, an institutional investor, you agree to invest in a hedge fund or a private equity fund, whatever the case may be, so long as they agree to adhere to the stated strategy or mandate that they've provided. No two, hedge funds would be identical, but they can, we can all sort of be categorized by different strategy buckets, and I'll get into that in the next page. What I think, again, we're also united by in terms of fundamental goals are performance, to deliver the best possible return relative to the opportunity set. Whether the markets are going up or down, we always want to have positive returns, and we'll adhere, to our strategy to try to make that positive return happen in every market condition. Risk management, where we try to avoid unintended risks or bets, especially those that have unfavorable risk rewards. So an example of that would be not taking excessive risk to express an investment that we want to make. There are lots of examples. I'm happy to answer any of those questions if people have them. And we want to be consistent with our returns over time. So a good strategy, regardless of how you do things, will always have consistent opportunity to generate positive return over time. It's difficult to always have a positive return, and investors aren't perfect. But the idea is that a good process will yield consistent positive returns over long periods of times, which will give the capital deployed a successful opportunity to continue to grow. So back to the point about how hedge funds can be categorized. If you look at online, if you Google online, there are a lot of different ways that you can sort of categorize what hedge funds are. And as I said before, I think these days, the words really hedge funds can just describe so many different types of opportunities. I'm going to attempt to define this into 5 classifications, but please understand you might read about more than 5. So this is my best shot. The first 2 are actually long short and market neutral funds. And I classify those together because they are really similar in most people's minds, but they are quite different. And I think it's important to discuss that difference here. So both market neutral and long short funds take long and short positions, as I described before, in securities in the hopes of generating stock returns. So, you could go, long one security and short another one in the same market. You could pick different markets, different stocks in different industries, different countries. It doesn't really matter. But the idea is you're always taking long and short positions in both long short funds and market neutral funds. The biggest difference is in that neutrality, what I said, sort of the net neutrality. So if I want to be long Coke and short Pepsi, just to name 2 random examples, I could do that in a way that has an outsized position in a long security or an outsized position in a short security, and I'm allowed to have an imbalance in assets long versus short, or exposure, I could say, to the, risk exposure, long versus short, in a long-short mandate. Market neutral funds, on the other hand, tend to neutralize these kinds of risks that people talk, market risks that people talk about. So it has a lot to do with, what we would call factors or exposures to certain dynamics in markets. One example would be, if you think about the market in general, for those of you who have studied things like CAPM or have studied market moves, there are ways, if you have a stock that goes up $1 and down $1, that's neutralized. And we can obviously spend more time on that for anybody who wants to. But the point is that market neutral funds try to construct portfolios that really neutralize shifts outside of stock moves in markets, so that they tend to only focus on the absolute return of a stock, one stock versus another. So that's kind of the first two buckets, is they are long and short securities. One is positioned to be more neutralizing of risk than the other. Event-driven funds, on the other hand, actually look to capture gains from the market for events, and focuses more on the volatility of market moves. So not thinking about factor moves at all, really just focusing on an event happening and capturing volatility from things like a merger, natural disaster, or political turmoil. So if you, for example, think about a stock that might be experiencing potential takeovers, you would try to construct a portfolio that would capture the volatility move of a rumor of a takeover, rather than caring about whether the fundamentals of a stock were driving the market, that stock price up or down. So in other words, it's more about an event that's driving movement in a stock rather than the fundamentals itself. So the first three talk about stock movements. If you actually prefer instead to think about asset class movements, one versus the other, dollar versus gold, silver versus platinum, country versus country, you might want to go long short asset class representations. That's what a macro fund does. They actually take directional bets or relative bets. And again, relative is one versus another versus just having a view on one market or another. And they try to, macro fund strategies try to make profits based on viewpoints of having arbitrage across asset classes. As I said, it can be representations of geographies through stock market indices. It could be based on commodities. It could be based on representations of fixed income versus equities. Whatever the case, they tend not to invest in stocks, but rather in derivatives, indices, or whatnot that represent asset classes themselves. And finally, quantitative funds kind of are in all of the above. We hear a lot about them now. We read a lot about them now. The firm, my firm, Point72, has a quantitative fund as well, where that's really about selecting securities based on quantitative analysis. And managers of those funds build computer-based models to determine whether an investment is attractive. So that's kind of a very, very broad overview. And it depends on the strategy to determine what you do every day. And there's a lot of good things that people, at Point72, for example, will do every day. We're primarily a long short fund, as I talked about before. So we have views on wanting to take securities long or short. So in that particular career, and in many like it, you actually spend a lot of time as an analyst starting out in this business, researching and building strategies. So if you're at a quantitative fund, you might develop algorithms, statistical methods, often involving some programming, where the orientation there is to try to find an algorithm that's suitable for certain market states, where you can capitalize on patterns and trying to invest in stocks, indices, representations of stocks with pattern recognition. As I said before, if you are in macro, you're focusing more on asset class arbitrage. So you're focused on economics, policy analysis, maybe likely some quantitative work as well. My own background is with the fundamental business. So that's really getting behind industries and companies and understanding due diligence on companies and what makes an attractive investment, what makes an unattractive investment, and then going long or short stocks accordingly. This is a highly varied field. But what I think is always in common is that you're very detailed in your work, you get very deep in some expertise, and it takes a lot of time to learn. You then have to articulate all the information and data you collect into what I would say investment theses or recommendations. You might prepare memos, you might write reports, you might articulate verbally with your portfolio manager. But the idea there is to synthesize all of the information you collect researching and building your strategies and delivering it in a monetizable way to your bosses. In order to gather this information, it's kind of, for me, the most fun part. You can attend industry conferences, You meet with management teams starting at a very young age. You learn to ask great questions. You learn what to do with the information you collect to ask the next great question. You do a lot of thinking, I think, and you do a lot of financial modeling and a lot of forecasting. So what I've always liked about this business is that there is such a broad range of opportunity where you get to be an expert, as I said, at a very young age. It requires a lot of mix of analytical skill and ability to communicate findings. I think articulation cannot be understated. This is a business where you really only have a moment to capture everything you've learned and deliver that succinctly to your portfolio manager. And you're always learning, right? There's always the next data point. The market is a report card. And, you know, I would say, unlike private investing, which I did a little bit of in my career, what I've found is that you always know where you stand in public investing, but there's always the next data point to be looking for. And you have to be hungry for that. And you have to, the entire job is to know more about the markets than anyone else. And that makes it very competitive. And I think anybody who likes to have a report card all the time is probably a competitive person, and it's going to be very attractive as a profession for them. That also means success is well-defined and easily measured, but so is failure. And I guess you could put that in the con category. You have to be very comfortable with failure. I think so many times, you know, the statistics show that investment analysts and hedge funds and other, you know, securities are right only about 53% of the time. Picture how many A's and B's you've gotten in school. That's not a 52. And yet 52 is what we strive for to be good in this business. And so being comfortable with learning from your mistakes has to be something that you're good at. I guess that means I got to the con category a little bit early. But I think also on the flip side of that, being successful also feels really great. So, you know, beyond that, I think, you know, there is a lot of solitary work. I think at least for me, being able to learn a lot means I have to do that in peace. I can't do it playing you know, a lot of music in the background. I can't do it with a lot of people around me. So that does require some solitary thinking. And I agree with the comment, you know, Charlie made, you know, it is easily vilified, although it is intellectually fulfilling. And I think sometimes we read about things in this business that, you know, can make it feel not so great all the time. But at the same time, I feel like, you know, if you're up for the intellectual challenge, this is rigorous and that can be very rewarding. So I don't know if I'm into.
Kevin, you're on mute, Kevin.
Yeah.
Great. Thank you both, Charlie and Jamie. That was super informative and really helpful. I think we'll now move into the panelist question portion. We've been getting a bunch of great questions from the students flowing through. So maybe to kick off, let's have all of the other panelists introduce themselves, maybe starting with John.
Sure, I'd be happy to do that, Kevin. Hi, everyone. My name is John Smith-Rico. I currently serve as a director of in the portfolio team at Centerbridge. We actually do both public and private investing through our 3 closed-end vehicles, but I focus on the private equity side. You know, you'll recall in Charlie's presentation, he showed the spectrum of what you actually do from deal sourcing down to portfolio management. My role is mostly focused on the portfolio management side, working with CEOs and executive teams of the various portfolio companies that we have on various projects, you know, mostly related to making the companies more valuable so that when we sell them, we're much closer to that 3+X than the 2X that Charlie spoke about in his example.
Great.
And is there anything else I should share? Sorry.
Anything else you want to share?
In terms of educational professional background, I went to Carleton College for my BA. I was a history major, and I have an MBA from Harvard. Prior to Centerbridge, I spent most of my career in management consulting at Bain & Company.
Great. Super helpful background. Maybe I'll kick it over to Alex.
Yeah. Hi, everyone. My name's Alex Smith. I'm a principal at Ares, where I'm part of our alternative credit team. Ares management being slightly different than what Jamie or Charlie went through, in that they kind of focus more on the equity side. Ares is really born up as a credit institution, so financing a lot of acquisitions that maybe Charlie's doing or done with Centerbridge. So where you'd usually the debt in that example, if you remember the LBO example there. My team within alternative credit, we focus on, we're kind of the alternative in the credit space. So we kind of deal with, mainly private, unilaterally negotiated transactions. So there aren't usually sponsored. We're kind of going out, pounding pavement or finding opportunities via relationships. We can kind of run the gamut in what we're looking at. So we can do really complicated sale-leaseback transactions that involve larger industries. We can do rescue transactions. Right now, it's a pretty interesting time for us given COVID, the impacts in the industry that are happening there. But so slightly different than I think some of the other examples so far. My educational background, I went to Ohio State where I majored in finance. And I basically have spent my whole career at Ares.
Great, thanks, Alex. And last but not least, Steve.
Hey, I'm Steve Bosse. I am a managing director at Goldman Sachs. I work in the asset management business that focuses on alternatives. So most of my time at Goldman, well, actually really half and half, I've been focused on Jamie's world. So looking at hedge funds on both the event and the credit side. So that volatility and the mergers that she was talking about, that's very, very familiar territory for me. But the other part of my job actually focuses on the private market. So I focus on private credit, and actually we do business both with John's firm and Alex's firm. Sorry, Charlie, we see you on the private equity side, but not on the private credit side. And look, it's interesting to kind of, I have to worry about both sides of the equation. Jamie's right. You get your mark to market pretty quickly on the public side. However, you can't really ignore the private side because it really does kind of catch up with you. So it is the difference, I think, in my job relative to what everyone else is doing. I actually, the business that I run actually invests in funds. So we'll invest in one of Alex's funds or one of Jamie's funds, John's funds, or Charlie's funds. So the work we do is probably similar to what Jamie described, but it's just done at the fund level rather than at the security level. In my background, I graduated from undergrad from University of Connecticut. I went to business school at the University of Chicago. And when I came out of business school, I started actually as a fixed income investor. So actually trading securities, mostly in the corporate, in the mortgage-backed area and treasuries. And then I transitioned over to the really more of an allocator to different funds a little bit later in my career, but I've been doing that for the last 20 years.
Great, super helpful background. And I think we have some questions on the screen, but we've been getting great questions from the students also, and those are probably the most relevant. So I think I'll surprise all of you and go straight to some of the student questions. Maybe, John, if you want to take this one first. So there was a question around the macro disruption related to COVID and sort of how your job has changed or been altered on the investment side over the last few months.
Okay, good. I think you got me a little nervous there, Kevin. I thought you were going to ask me to draw some kind of recovery curve and ask about U-shape versus V-shape versus swoosh shape or something like that. But how has it impacted sort of my role and what I'm doing at the fund? There's been a big impact, right? So I think one of the things in my group that we're trying to constantly assess is sort of where do we want to deploy our resources, which are limited across the portfolio. So even if we may have, 20 something odd companies that we have control stake in, there aren't enough of us on the portfolio team to invest those resources. And in many cases, based on the check size or just based on sort of where those companies are in their life cycle, it wouldn't be appropriate for me to be spending 30, 40, 50% of my time there. What COVID has done is it's really shaken things up. So there are companies that I'd never stepped foot in, CEOs that I spent relatively little time, that suddenly found themselves in positions where, let's say, their income statement and then their balance sheet eventually wasn't as healthy as we'd like. And so there's a set of tools and a set of assessments that we kind of deployed there, and I had sort of had to parachute in. Galvanize resources, set up cash management processes, make sure the 13-week cash flows are tight, things that, quite frankly, we haven't deployed in any large way since the financial crisis. So that has certainly, the content of my work has largely changed, though, so the way I do my job has not changed much at all.
And Alex, I'll kick the same question to you, just because on the credit side, this can sort of be interesting. And I'm not sure if you've worked on a lot of restructurings or what you've been focused on, but same question.
Yeah, I think it's been a very, very interesting time for all of us across the board. So I'd say in March, April, May, really a lot of focus on what John was saying, the portfolio, our individual investments. First of all, making sure that we felt good from a credit standpoint, that the businesses are going to be okay. Now, my world, I primarily invest in financial assets. So I'm investing in mortgages or small business loans or things like that, which have contractual cash flows and analyses that I can look at to feel a little bit better about my position. Whereas on our direct lending side, investing in more traditional businesses at the corporate cash flow level, a lot of the work there is around liquidity. Can the businesses continue to operate? And what do they need to get through this time? So it's really an assessment. Do the companies have liquidity, the ability to continue their runway, working with private equity firms and others oftentimes, trying to figure out some situation where the private equity is probably putting more money in, us as the lenders are putting more money in, and we're making sure the businesses can get through this period. There's also needs to be a shift in operation for a lot of businesses. How do we work with our counterparties and our borrowers to make sure that they're shifting their business to, if they can, take advantage of the situation by maybe seizing market share or shifting how they operate their businesses primarily. Maybe they were to traditionally storefront. They have to shift to more of an online focus. How do you set that up? What liquidity needs are associated there? And then the second part is how they just make it through so that they can get back to a normal operation of the business. If they can't pivot to take advantage, then the focus is how do they survive?
Yep, that's super interesting. And I think on the real estate side, I've seen the same thing. I mean, I work in real estate investing for everyone's benefit. And when you think about just how people are actually acting, people aren't going into the office, so people aren't paying. So you have to think about how do you work with your tenants and at the building level and property management level. And so definitely agree with all of that. So maybe I'll shoot a question over to Steve. So how have you thought about capital deployment during this environment? And how have you been thinking about your portfolio and putting out more money? Because I know that at least in the pension world, there's been a lot of activity as people have gone in and out of positions. Anything of note on your end?
Sure. It's been a really busy but super interesting time. Anytime there's a credit crisis or some type of a major market dislocation, I think that's fair to call what happened in March as a pretty major market dislocation, at least for the short term. There was a lot for us to do. So, initially one of the things, and I'm going to talk a little bit more to the private side, because I think the hedge fund side, generally speaking, came through this okay. On the private side, we were in the fortunate position to put some capital out. And so the areas that we look at, direct lending would be one of those, but distressed would be another area. And clearly with the COVID situation causing many companies to basically, or economies basically to shut down, people in our industry, I think we're very fortunate because we all, generally speaking, have kept our jobs, but that's not true for everything. So if you think about what's happening in mortgages, for instance, people can't pay their mortgages. If you think about the doctor's office, who maybe is a dentist or a physical therapy, those offices were closed. So that created a lot of opportunity that we could look at either for putting new capital out and not really a distress per se, but the two big areas that we've been focused on is looking at how do we take advantage of this from a distressed debt perspective, recognizing that there are some companies that are going to be impacted today. Think about JCPenney, think about Lord & Taylor. That may or may not be an interesting opportunity, but look, there likely will be some really interesting things down the road because things will take time to kind of percolate through the system. When I say things, I'm really talking about defaults. So that's been one area of focus for us, and I think we're pretty well situated for that. But the other big area is in the mortgage space. And Alex touched on this a little bit, but think about it, whether it's a commercial mortgage, whether it's a residential mortgage, whether mortgages are paying or they're not paying. That's been a big area of dislocation and really trying to understand, is a hotel going to get back to occupancy anytime soon? Or is a cruise liner going to get back to capacity anytime soon? And all of these entities have debt on their assets, but that debt still needs to be serviced, and you need cash flows to service that. So we've really been focused both on the, let's call it the broadly speaking structured credit, whether that's a mortgage, whether that's some type of an asset-backed security, and or on the distress side, where we think there are some pretty good opportunities, but perhaps maybe a bit early for that, but certainly on the come.
Yep, definitely an interesting space. And if you know when cruise lines or hotels are going to fill back up, give me a ring. I'd be happy.
We'll let you know.
Yeah. So next question, I'll route to Charlie. So this is a question on sort of governance and sort of how you think about that sort of level of transparency that you do provide in your sort of portfolio and in your investments. How is that something that Warburg has thought about and sort of focused on when you are doing LBOs, when you are acquiring companies, and just generally speaking, thinking about adding leverage and sort of adding debt to a structure?
Sure. I think so. We try to be thoughtful and prudent about the amount of leverage that we put on the balance sheets of companies that we acquire. So, look, there's a couple governors, right, on the amount of leverage that you can put on a company. One, increasingly in the last few years, interestingly, is actually government regulations. So coming out of 2008, 2009, as part of the prudential financial regulations that were put on the banks, the Federal Reserve put out some pretty strict guidance about what were appropriate or inappropriate levels of debt to be putting on the balance sheets of companies. Interestingly, the intent of that was really not to protect the companies from the rapacious private equity investors, but to prevent the banks from, putting loans on their balance sheets that would not be able to be repaid. So that's been one factor. Another is just the underwriting standards of the people that are lending us money. Someone is not going to take a retailer like JCPenney, like Steve threw out, and lend it 10 times its annual earnings. It's just not a realistic ask. So that there is a natural tension, I think, in our private equity investing of, on the one hand, there's an incentive to take as much leverage as someone is willing to offer us, because that helps our returns. But on the other side, we need to be thinking about the downside and protecting our investment and making sure we're not putting these companies in a precarious situation where if things don't go perfectly according to plan, we're finding ourselves unable to pay our interest expense or otherwise defaulting. So look, we try to be thoughtful about it.
Yep, all important. And I think I'll route the last question, specific question to Jamie, and then I'll do just a quick run through, a final question to everyone because we're running up on time. But Jamie, I was curious, we received a student question about how is the hedge fund industry responding to the rise in passive investing, and how is Point72 sort of been thinking about that?
Sure. So you're talking about just the idea that we're competing more with more passive money, and I guess the question would be, how do we think about there's a couple of different ways I guess I think about that. Number one is you have an increase in volume on one side of the market, which is, passive investing is long only investing. And so, there's a question about, normalizing the volatility that could result from that, but which, maybe we saw for a moment earlier in the year. Or you could sort of take this in the direction of how do we compete knowing that there are, less expensive alternatives to investing, in which case I would kind of point to the earlier time in the year when the long only money can have experienced some significant volatility because they are only able, in fact, to be on one side of the market. And so the real differentiation you get when you invest in the hedge fund space is the ability to profit on both sides. And so I'm not quite sure which direction the question should, or the answer should take, but I kind of think about it both ways. Any guidance there? Or did I just answer it, I guess?
I think that's a little bit like, that's the right answer. There's multiple ways to think about it. So I think that's probably adequate given we're running up on time, but I did want to run through, just because of course O4U is a queer-focused, LGBT-focused conference. Everyone, very quickly, I'd be curious, starting with Alex, sort of how has your LGBTQ plus identity impacted your work life, or how you thought about working in the alt space?
Yeah, I think it's really interesting, because I think the alt space is going through this little bit of a growing up phase. Before it was very clubby, very boutique, small. At Aries, we've seen over the last 7 years grow from 300 employees to 1,400 employees. And I think with that kind of growth across the whole space, not just within Aries, but and everywhere, there's this greater focus on inclusion and diversity. So within Aries, we've spent the last 3-4 years really trying to build out that piece. I was fortunate enough to actually be a co-founder of Out at Aries, which is our LGBT plus ERG at the firm, and it's been a great experience. The support we've seen from the top down has been incredible. I was kind of curious how it would play out as we built out the group and started hosting events and started pushing for changes with benefits and other programs, and it's been fantastic. I would say it has impacted me in a way that I feel like I'm now in a position where I can help influence changes that improve benefits and improve visibility and support across the firm. And I think that's been great, but it's still early in this industry. I think they don't have the breadth of a bank or consulting firms. You know, you kind of have to right now, I think, pound the pavement to build out the niche within alt credit or alternative investments broadly.
Great. Yep. I definitely agree. John?
Sure, I would echo those same sentiments. I think the kind of programmatic maturity in this industry is not there, at least speaking, you know, for firms like mine, not people who are coming from part of a larger institution. But I think in terms of how it's impacted my career, you know, I think as someone who probably spent too much of my life observing and thinking about what people thought of me, how I was perceived by the world, I think later in my career that became a benefit. So when I go to companies and I'm talking to executives and I'm trying to understand how we create value, I'm very good at picking up sort of the unspoken cues and understanding what people are worried about and thoughtful about. So I think having an LGBTQ identity has made me a more empathetic person and a better listener, and it's something that has served me well in my career.
Great. Steve?
Yeah, look, I would agree with the comments that have been made so far. You know, I'm very, very fortunate. Goldman is a very open place, very accepting place, whether you're a person of color, LGBTQ, it really doesn't matter. What really matters at Goldman is, are you getting your work done and are you doing a good job, right? So from my perspective, my identity has never really been an issue at work. The one thing I will say about Goldman, that this is a personal story that struck me. My now husband, then partner, was a non-US national. And when Lloyd, the former CEO, kind of got on the record of supporting marriage equality, that was really important to me because we were at a point in time where we'd been together for about 15 years, but my partner at the time had to live overseas. So things like that are meaningful and impactful. And I think the message it sends, not just to me, but other people who are like me, is that, you know, your differences are okay and they're important. We want you to bring your whole self to work. So I think that's super important. And I think on how it's really impacted me professionally, look, I do think listening and picking up on cues, I think John's right. You know, I stopped worrying about what people think about me a long time ago because you can really drive yourself crazy. And the reality is, you know, a funny story, when I came out to my brother, a family of 5 kids, I came out to everyone except my brother, who's a carpenter, that I was terrified to tell him. And he said, Steve, I figured it out a long time ago. I just hope you're happy. You know, and I think that's really I've been fortunate. That's really been the response I've gotten from most people. So look, I think just it's important to be yourself. Any minute you spend worrying about what people are going to think about you is just a minute wasted, and time is precious.
Great. Well, unfortunately, I'm very late on time. Charlie and Jamie, I just want to say thank you for presenting. I'm going to have to skip you, unfortunately, but really a big thank you to all of our panelists. I think super helpful, super interesting, and we had so much excitement this year about the panel. So thank you to all the students that hopefully enjoyed this and asked questions. please drop and immediately join your next industry education sessions. All right, thanks everyone.
Thank you.
Thank you.